Hello friends, today we are going to learn about financial management for TYBBA SEM 6. I am Assistant Professor Sri Rajbor. Let's go through with what is economy. What is equity shares? Equity shares represents ownership in a company, granting shareholders voting right and a share in the company's profits through the dividends. They are also known as common stock or ordinary shares and are a primary way for companies to raise capital. So key features includes ownership, voting rights, potential for capital appreciation, then potential for capital appreciation, a claim on company assets in case of liquidation. So equity shares means those who are real owners of the company, risk takers, they are having voting right. They are also called as ordinary shares and they can claim on assets of the company. Next go through with the features of equity shares. First is ownership stake. So equity shares represents the fractional ownership in the company. Shareholders becomes the part owner with a stake in a company's assets and earnings. So this ownership allows shareholders to participate in company's growth and success. So when any shareholder purchase shares of equity shares of the company, so that person is having ownership right. So this is called as ownership stake. Next is voting right. So equity shareholders have the voting right to vote on important company matters such as electing directors and approving major decisions. So these voting rights allows shareholders to influence the direction and future of the company. So voting can be done in person or by proxy. So it is right of shareholder to appoint proxy if it is not possible for that shareholder to attend any meeting. Third is potential for capital appreciation. The value of equity shares can increase over time as the company's performance improves. So shareholders can potentially profit from selling their shares at the higher price than they purchased them. So capital appreciation automatically increase because all the shareholders are having capacity to take the risk. So because of risk, the market price will also increase, and definitely in near future there are chances to have capital appreciation. Next is dividend entitlement. So equity shares entitle shareholders to a share of the company's profits, typically distributed as dividends, and the dividend payouts are not guaranteed and depend on the company's financial performance. So dividend come out of profit. So if company is in huge amount of profit, they provide dividend to the shareholders, and it is totally depend upon the profit of the company. Next is residual claim on assets. So in case of company's liquidation, means winding up, equity holders have a claim on remaining assets after all debt and liquidities are settled. So company must pay first all government dues, third party liabilities, then they will pay all the liabilities, and when if it is amount received, then that will whole amount will be owned by equity shareholders. So this claim is lower than the claim of creditors and preference shareholders. So equity shareholders are having huge benefit in case of residual claim on the assets. No fixed return. So unlike bonds and preference shares, equity shareholders do not have offer to fix return on dividend rate. So return are depend on the company's profitability and market condition. So it is not compulsory for company to pay dividend every year. Equity shareholders get dividend after 2 or 3 years, but amount of dividend is quite high. Next is risk and rewards. So equity investors carry a degree of risk as shares prices can influence based on the market conditions and company's performance. So however, equity investment also offer the potential for higher returns compared to the other investment options. So risk, if they are going to take risk, then definitely they will get huge amount of